The notice hit his inbox at 6:42 a.m., and by 9:15 his business account was frozen. When Daniel Mercer logged into his bank that morning, the balance still showed available funds. But the transfer he tried to send to cover payroll failed with a single, sterile message. Account restricted pending government review. By noon, his processor had suspended outgoing payments. By 3 p.m., he was staring at a federal assessment totaling $684,000. It wasn't a warning. It wasn't a request for clarification. It was an official payroll tax assessment tied to an AI-triggered audit and a contractor reclassification review that had already escalated beyond his control. Daniel was 42 years old, founder of a fast-growing digital marketing firm specializing in cross-border e-commerce brands. His model was lean, remote talent, international contractors, automated payroll systems, and aggressive reinvestment into client acquisition. For 4 years, it worked flawlessly, until the systems started talking to each other. The first sign of trouble wasn't even from the tax authority. It was from his payment platform. A routine compliance review flagged inconsistent labor classifications between domestic Form 1099 filings and platform-reported compensation data. The algorithm noticed that several independent contractors were receiving predictable biweekly payments that mirrored employee payroll structures. The platform shared the data. The tax authority's AI system cross-referenced it, and Daniel's file moved from low-risk to high-priority review in less than 48 hours. Within 2 weeks, he received a digital notice requesting clarification on worker classification practices. It cited behavioral control factors, financial control indicators, and permanency of relationship metrics. He skimmed it, forwarded it to his bookkeeper, and assumed documentation would be enough. It wasn't. The second escalation came fast. An automated review compared his contractor expense deductions with state-level unemployment insurance filings. None existed. Yet transaction-level payment data suggested over 70% of his contractors worked exclusively for his company, used company-managed project systems, and attended mandatory weekly strategy calls. The system labeled it probable misclassification. That's when the AI-triggered audit formally opened. Daniel hired a tax attorney. They compiled contracts, invoices, and signed independent contractor agreements. On paper, everything looked compliant. But the investigators weren't focused on paper. They were focused on behavior. They subpoenaed internal Slack logs. They reviewed project management timestamps. They examined time-tracking metadata. And they found 2 compliance failures that changed everything. First, several contractors had been reimbursed for equipment purchases, laptops, monitors, even software subscriptions, through structured monthly payments. That suggested financial dependency. Second, internal policy memos required contractors to seek approval before taking on outside work that could conflict with client accounts. That implied behavioral control. The classification shifted. Overnight, his 14 contractors were reclassified as employees retroactively for 3 tax years. The assessment calculation was brutal: unpaid payroll taxes, employer-side Social Security and Medicare, federal unemployment taxes, state unemployment taxes, penalties for failure to withhold, interest accrual, and late filing fines. The subtotal crossed 6 figures before penalties were even added. When Daniel saw the line item breakdown, the number didn't look real. $684,000. $684,000. He thought it was a negotiating position. It wasn't. The third escalation came from the banking side. Under federal levy authority, once the assessment formally posted and the response window closed without full payment or approved installment agreement, the agency initiated a collection hold. His primary operating account was frozen pending payment arrangement. Payroll was due in 5 days. Clients were mid-campaign. Ad budgets were auto-debiting. Cash flow collapsed in less than a week. This wasn't just about taxes anymore. It was structural collapse. Daniel's business model relied on reinvesting incoming client revenue directly into contractor payouts and advertising spend. With the account frozen, vendor payments bounced. 2 major clients paused contracts within 72 hours due to campaign interruptions. Revenue dropped 38% in a single month. He attempted to move operations to a secondary account under a related LLC, but the cross-entity ownership trail triggered additional scrutiny. Beneficial ownership reporting tied both entities to him personally. That's when personal liability entered the equation. Because payroll taxes involve trust fund portions, amounts that should have been withheld from wages, the agency initiated a trust fund recovery penalty investigation. If determined willful, personal assets could be at risk. Daniel owned his home. He had investment accounts. He had college savings for his 2 children. The 4th escalation wasn't financial. It was psychological. Sleep disappeared first. Then appetite. He replayed every decision from the past 3 years, convincing himself there had to be a simple documentation fix. But misclassification isn't corrected with paperwork after the fact. It's corrected with structure before the fact. His attorney negotiated for an appeal review. During the process, another issue surfaced: cross-border compliance failure. 3 of his contractors were based overseas. Payments had been processed through a platform that issued international reporting summaries. But Daniel had failed to collect proper foreign status certifications for 2 individuals. Without those forms, backup withholding requirements technically applied. The oversight had gone unnoticed for years. Now it was part of the audit file. Additional penalties stacked onto the assessment. Interest compounded daily. The agency calculated that with penalties and interest projections over the next 12 months, the liability could exceed $720,000 if not resolved quickly. Cash reserves were insufficient. Credit lines were reduced once the tax lien filing became public record. Yes, there was a lien. The 5th escalation arrived by certified mail. Notice of federal tax lien. Vendors began tightening payment terms. A software provider switched him to prepaid-only status. Insurance carriers requested updated financial disclosures. Daniel wasn't being accused of fraud. He wasn't hiding income. He wasn't running illegal operations. He had built a legitimate business using a model that thousands of modern companies use. But AI-driven cross-platform data matching had exposed structural weaknesses he didn't realize existed. Stories like this don't come with warnings, and most people only understand the risk when it's already too late. The midpoint of collapse came when he had to tell his team. 14 people joined a video call expecting quarterly growth updates. Instead, he explained that their roles were under federal review and payroll might be delayed. 2 resigned within a week. 1 threatened legal action over unpaid employer benefits. Clients noticed turnover. Confidence eroded. The appeal hearing offered limited relief. Investigators reduced certain penalties after demonstrating partial good faith reliance on professional advice. But the core reclassification stood. The adjusted liability dropped slightly. It was still well into 6 figures. To avoid immediate levy expansion, Daniel entered into a structured installment agreement requiring substantial monthly payments tied to revenue thresholds. The agreement required strict compliance going forward: real payroll setup, unemployment registrations, withholding systems, quarterly filings. Operational costs increased by nearly 22%. Margins shrank. Growth stalled. But the damage wasn't limited to numbers. Daniel began questioning every strategic decision. Expansion felt dangerous. Hiring felt risky. Innovation felt like exposure. The AI audit had changed his relationship with risk permanently. In the final third of the year, revenue stabilized at a lower plateau. The installment payments drained cash flow but prevented asset seizure. The lien remained until substantial balance reduction. Investors he had previously been courting stepped back after due diligence uncovered the tax issue. His personal credit score dropped due to increased utilization and reported public filings. At home, conversations shifted from vacation planning to contingency planning. He kept imagining the worst-case scenario: forced asset sales, home refinancing, personal guarantees triggering additional collection actions. Even after compliance systems were rebuilt properly, the fear remained. Every automated email from a payment processor caused a spike in anxiety. Every government envelope triggered a physical reaction. He became meticulous, almost obsessive, about documentation. Weekly compliance checklists replaced strategic brainstorming sessions. The business survived. But it was no longer the same business. It was smaller, more cautious, more rigid. The six-figure assessment didn't just cost money. It cost momentum, reputation, and peace of mind. And the lingering damage wasn't visible on any financial statement. It lived in hesitation. It lived in second-guessing growth. It lived in the quiet fear that another unseen algorithm might already be scanning, matching, comparing. Daniel eventually paid down a significant portion of the balance. The structured agreement remained active. The lien would take years to release fully. He learned what many modern business owners are only beginning to understand. Automation increases efficiency, but it also increases detectability. Systems talk. Data matches. Platforms report. And classification decisions made casually during early growth stages can compound into catastrophic liabilities years later. There was no dramatic raid. No courtroom spectacle. No criminal charges. Just a series of automated escalations that, step by step, dismantled a thriving company's financial structure. The assessment letter sits framed in his office now, not as a badge of survival, but as a reminder. Growth without compliance isn't growth. It's deferred risk. And deferred risk has a way of arriving all at once. For more stories like this, subscribe to Tax Nightmares so you don't miss the next episode or the continuation of this story.